Hey everybody, welcome to the February market update. This is a little bit different of a format this time, just because I've got a lot going on and there's not enough time to really go into my full professional video making mode. I hope that you forgive it. But I just want to go over a couple things before we get into the housing numbers as we are seeing them currently. And I think that the first thing that I've had a couple clients over the past couple of weeks really kind of ask questions on as they propose different options for them to place their money, whether it be buying a home, buying a business, or investing in some kind of real estate, is that there's a general sense that there's a little bit of a head fake going on in the market. And we can see this because consumer spending is still pretty strong, and that is inflationary in and of itself. And we're also seeing the cost of goods, input prices still continuing to drive forward. This in itself is inflationary. And the Fed is still not in a place where they have met their 2% target. So for everyone out there who continues to bemoan the talking heads on TV, oh, the worst of it's over. No, it's not. We still are going to see rising rates. You can anticipate it in the future. So that means that we have to be more deal oriented. You know, are we seeing a house or a home that we're going to potentially see ourselves into for the long term? Are we buying in an apartment building where, you know, the rate of return is actually commensurate, or the purchase price is commensurate with, you know, what it's going to cost us to own it? I don't anticipate, and I know the market does, I do not anticipate a reduction in rates for mortgages over the long term. I expect rates to normalize. The 30-year average, not the 30, since mortgages have been around since the 1960s, the average 30-year mortgage rate is 7.5%. And I continue to beat this into people's heads because they're not quite listening to what I'm saying just yet. We just came out of a decade-long period of historically, artificially low mortgage rates. Mortgage rates they're normalizing right now, which means that we're probably going to see them float between 5.5% and 10%. Now you're sitting here going, 10%? That's terrible. No, for those who were around in the 1980s, mortgage rates were anywhere from 15 to 20%, and that's kind of the peak of everything. So as investors start to calculate risk, which is how the 10-year and the 30-year and all the mortgage rates are calculated, as they calculate perceived risk in the market, it's what they consider their safe rate. So if they park money into it, how much should they get back based on the perceived risk of the economy? That's called a safe rate. Real estate and real estate investments are considered the next stage down from the safe rate of bonds. Stocks and crypto, that's considered somewhat speculative. And so the rate of return should be even higher than what that is. And we're just not seeing that in the market. And we're not seeing that the curbs in spending curved yet. What we're seeing is that the prices that the consumer is paying is more. And so it's still driving revenue some. But as the consumer continues to slow down, I think we'll see that this will adjust in the stock market as well. We just haven't seen it yet. It just takes a little bit of time. So that said, do I think that we've seen the full pullback from this yet? No. Do I think a recession's coming? Yeah. It's hard to say how deep. We're not going to see a housing crash by any means. I think that is... anyone who's running around saying that the sky is falling, no, it's not. Little bit of perspective on that real quick. The average mortgage rate that people have right now is well below 5%. Most of the people who saw historically low mortgage rates, they locked it in. So they're not really in a position to have to sell. It doesn't make sense for them. The ones who will have to sell are the traditional kind of rollover in real estate, which is going back to historic norms of, did somebody die? Did somebody get born? And did somebody get divorced? I hate to be crass, but that is really what moves almost all businesses. And that we're going back to that kind of norm. So when we look at the numbers, I've already kind of previewed them a little bit. We're going to see how this is starting to play out into the market. Now, does that mean that prices are going to crash? No, they're probably not. And the reason why is because the lack of supply in the market is not greater than like it was in 2008, 2009, when we literally had a housing crash. I know the media is going to be out there talking about the increase in foreclosures numbers. Well, when you're coming off of a 0.5% of total sales or the market being in foreclosure, that's an easy thing to run around with your head cut off screaming. That is not the case either. We're probably not going to see that bad of a foreclosure market. And I'll show you what those numbers look like as well here in a second. Lastly, the areas where we probably are going to see deep discounting, and we probably are going to see some pullback and defaults, we're going to see that in the commercial real estate market, just because the rates and the investments were speculative. I've already was reading a Globe Street article earlier this week that talked about how one building owner who owns 2 buildings in downtown Los Angeles, they're defaulting on their mortgage. And even though they got extensions, now they're defaulting. And these are really, really, really big high dollar loans. And those are for office buildings, which is to be expected because getting people back to work right now is pretty hard. So let's jump into the housing numbers and let's see how this is kind of playing out overall in LA County. We're going to skip the national. I know I'm punting it again, but there's a reason. I just want to kind of keep this one short. So let's jump into the LA numbers real fast. 1 second. Okay, so let's just kind of start with residential. So these are single family homes, and we're looking at, what's going on with the market. This is the number of new listings on markets. We have seen some bounce into the number of new listings, but we noticed this really, really deep low. And this is going back to 2008. So you can see how many listings were on the market, new listings were coming on market in 2008, over 10,000 in LA County, whereas now we are literally at below 4, like 3,398. That's really, really low for January. The number of active listings is still historically low. So what does that tell us? And it kind of tells us that the listings that are on market are the ones that might have fallen off at the end of last year, and now they're coming back on and trying to sell again. The number of pending sales in single-family homes in LA County is still, this is an all-time, this is over a decade, 15-year low. I mean, when you look at 2008, that's pretty low. Let's see how low it is see how far back. Oh, that is the max. So that's as far as we can go. The data goes right now. But that's still much, much lower than the previous 2020 low from April. So that's a very real trend now. So sales are down, listings are down. The number of new listings got a bounce, but it's probably the people who could not sell because they could not price in correctly towards the market. When we look at closed sales, again, we are now below that 2008 number. So what does this mean? Well, the number of the sellers that are out there are going to have to adjust their pricing. Does that mean a crash? Well, let's take a look. When we look at closed volume, transactional volume is still down. We're still at over 4,800 million in closed transaction volume in LA County. But again, if you just take the broader chart here and look at it, you can see that it's definitely trending down, and we're probably going to get closer to this area right here before things really start to turn. And forgive the flashing numbers that are popping up. Days on market, the median is at currently 31, but the average, this is where it changes, is 44. So remember that days on market, when it gets up to 60, that's kind of more of a normalized market. Anything above that, 60 days on market, 100 days on market, that's really where you start to venture into a buyer's market. We're not there yet. So, but we'll continue to watch it. The median still sitting at 31. The amount of supply that's out there, remember how I was talking about really low inventory? We're still there. That's 2.2 months. we're not seeing the growth that we really need to see in supply. When we contrast that to, say, 2008 at a peak in May, there was 14 months supply. 6 months supply, which is right in here, is considered a normal market, right? So up here, we're not there yet. And the low supply will be supportive of pricing, but only to a certain point. And we're just watching this play out real time. That's what we're doing. So when we look at the median price per square foot, it has pulled back from its peak. The peak was, May 2022 for $637 per square foot. We're now at $546. So how much is a percentage of original list price? We're going to use the median here because we want to lop off, the really expensive and the really cheap. The really expensive could be 50 million and the really cheap could be like $10,000, depending on what it is. I'm being hypothetical here, but that's kind of what it really looks like. So as a percentage or a median of original list price, we are at 97% of original list price, which means sellers are having to take a 3% haircut in order to sell their homes. That's not the deep that we can look at when we go back to 2008, where it was almost a 8.5% haircut of original list price to sell their home. So 10% chop. And then for our median sales prices, we are now at $850 with a peak of $999, $999. That is basically $1 million peak. We're down the median. This is everything. This is not just, the big mansions or the small little toolboxes that need to be completely torn down and rebuilt, is 850,000. So that's kind of the single family numbers. We can see how it's starting to play out. Do I expect it to get, down here? No, I really don't. If we start seeing it at 685 as a median sales price, I think the market's going to go gangbusters again, and it's just going to shoot the price right back up again. And part of the reason that is that, again, we're at really, really low inventory and people don't have to sell. Let's take a look at condos and townhomes. We're going to take that out. We're going to take that out, and we're going to go over here. So condos and townhomes, number of new listings is down again. It had a little bit of a spike. My assumption is that at this moment in time that all those new listings are listings that could not sell last year that have come back on market again. So number of active listings, we'll see if I'm correct. Yeah, I am correct because the number of active listings, it's already up here. We're still extremely low. This is 2,381. That's still 11% decrease from, the previous January. So that's inventory is running tight right now. So, if you're a seller, you can still sell, you still get it done, but it might just take a little bit of a haircut off your price. And we'll talk about that here more in a second. Pending sales, I'm assuming are falling way off, and they are. They're almost at our decade lows right now. And the number of closed transactions, again, we are way, 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 way down. This is all-time low since 2008. And that should tell you something, that buyers are shying away from the market and they're not necessarily closing unless there is some kind of a discount that is appropriate with cost of ownership or their monthly payment. So we don't need closed sides. We need closed volume. Yep, there it is. It's still falling. The closed volume, we're at 1,115 million for condos and townhomes. The days on market, come on. So days on market, again, we're at 32. We recalculate for the average, we're at 45. So the single families and the townhomes and condos all seem to be trending around the same rate right now as far as days on market. Months supply, still extremely low, 2.1, kind of the same as single family homes. And price per square foot, we're going to look at the median because we don't want to look at the extremely high or the extremely low. We've pulled back. We're still at 529. So when we go to the percentage of original list price, the median, I think we're going to see the similar. Yep, 97.7% of original list price. So that's about 2.3%. haircut off of original list price that sellers are having to take in order to sell their properties. And then when we look at the median sales price, again, we had a little bit of a spike up. That could just because of sales, but 625 compared to the low 600 and the high of almost $700,000. So things in that area are still progressing forward, and they are still showing that sales are happening, but sellers are having to discount some in order to engage and keep stuff going. We're going to take a look at one last thing. We're going to look at the residential income market, and let's just look at the number of new listings on the market. So this is kind of the overview. The residential income side did not come through like I wanted it to, and I know I wanted to show it to you, but it just didn't happen. Overall, like I mentioned before, the market is reacting somewhat to the higher interest rates. We still have to monitor it to see where it goes. We are expecting that, we will see sellers continue to have to take a haircut on their property prices in order to appease, if you will, the buyers in the market who have to pay more on a monthly payment. When you look at the mortgage rates at 3% versus a mortgage rate of 6%, it's essentially double what they were having to pay for a property previously. So it's important for sellers to keep that in mind. And just recognize that from 2020 to 2022, we just saw really impressive inflationary gains in housing. And that those artificial gains that came from inflation are not necessarily a reality. So can you sell your home for more than the price that, that was valued in 2019? Yeah, you can right now. How long will that last? We'll see. Right now, that's the case. So if I'm a seller, I'm going to look at it like that more so than I am prior, than when the government was dumping $10 trillion into the economy. So my name is Dennis Maynard. I'm a mortgage broker. Real estate broker here in Los Angeles. And if you need any help buying, selling, or listing, or investing, let me know. We're here. Look forward to chatting with you.